Markets May, and today we're going to talk about the consumer credit companies. Even though there's a part of me that really wants to take a victory lap on Tesla, as you guys know from the other days. But the consumer credit companies, we have American Express that just reported, Visa reported last night, MasterCard reported, and then all through last week, we had the banks report, et cetera. And consumer credit is becoming such an important facet of what's going on. And I truly believe that whether or not we make it through this soft landing, you're going to have to pay attention to what the companies actually do, not just arbitrarily look at the economic data. And I look at all of it. So, I will report on what I'm seeing and then you can form your own opinion. I'm going to share my screen, but we are going to talk about MasterCard, Visa, American Express, Discover Financial. And then I'm going to give you kind of an overview of what some of the banks and various companies did so that you can create a framework to think about the next few quarters. Because this is a multi-quarter play. And for sure, the financial companies, in particular those that work in consumer credit, are taking a true strategy that either will work or it will end in tears. And I think it's really going to be fun for the day traders to get into this. But I also know that the way that people talk about these companies makes it nearly impossible for anyone to understand them. So we're going to unwrap some of that in this episode as well. All right, past performance, it's not indicative of future returns. I'm going to share my screen. The first thing I'm actually going to go through is the PCE data to set the stage of why we care, why this is so important. Let me just see. I gotta give a screen. Okay, so hopefully you guys can see this. Hopefully you guys can see this in my screen. This is the PCE data, and it came out, in my opinion, mixed, but obviously the market reacted positively. And I think that one of the things you'll have to watch for is why the market's reacting positively. I don't think it was off of this PCE data. I think it was just because the strong strength of certain large components within the indices is just dragging that up, and we definitely have FOMO in the marketplace right now. But if you look at it, relative to estimates, PCE came in right where people wanted it to. The year over years came in a little bit better, but if you look at CPI, it's still kind of mixed and hard to say. Core actually came in better on PCE, but that was not the case for CPI. So it can be kind of a mixed thing. Next week, you have two big Fed things to watch for. First, we have consumer confidence that'll come out. I'm pretty sure that people are going to be less confident just because of all of the mix of what's been happening. And then you've got your Fed funds on February 1st to start out this month and the press conference. That can always be a whammy. You do want to be careful as a result of how much length you put into the marketplace. Make sure you have a little cash just in case so you can watch it. All right. What does this end up having to do with consumer confidence? We are at kind of a precipice right now, and it's just starting to trickle in. I have been saying it, though, for a while. In fairness, you can go back to my videos because it's all logged. It's going to come down to what do we think about the China reopening and what pressure does it seem like? Hold on, I'm not sure if my stream is having an issue. I'm hearing. Hold on, let me just make sure. Oh, yeah, let me get rid of this. Sorry, guys. I think my stream was having a little bit of an issue. Hopefully you guys can see me. Maybe someone can stick in the chat that they can see me okay. Anyways, when it comes down to it, what it's going to come down to is, are we going to have a soft landing or not? And what is the impact of China reopening? Because it's definitely reopening. Will it create inflation, or will it actually take some of the pressure off the United States in having to support Europe through a resource constraint that it necessarily has? And there's a lot of people that think otherwise, but we shall see. And so the consumer piece of America is what's allowing us to do a set of activities, namely continue to maintain this very tight environment and ship stuff over to Europe, quite frankly, right? But the thing is that you really have to understand is when you look across all of the numbers as relates to how much the US markets are being constrained in energy, like I think we're using 17 million barrels, something like that, versus 19, which is what we used in 2019. But quite frankly, if you start turning the knobs back up on this economy, you could easily see us going back up to 19 in a flash, and we would then not be able to export quite the same way that we are right now. There's all these little baby things that are happening, but the degree to which the consumer can hang in there is everything. And right now it looks like it looks very interesting. It's like on a wire. So let me show you what these guys reported and then really get into the consumer credit space. Before I get into what they actually reported, though, there are so many things that I'm seeing that suggest that possibly this is just, you won't be able to understand the credit card companies unless I unwrap the stuff that's wrong in the marketplace. And namely, it's this. MasterCard and Visa have no credit risk. They are pure plays. They are data processors and outsourced services. American Express, Discover, and the other card companies, everyone else is attached to a bank. It does actual consumer lending. It takes on credit risk. So it should always be the case that MasterCard and Visa trade at a significantly higher multiple than everybody else. Okay. That's the first thing that you have to know. Additionally, it is not the case that it will ever be that some rando fintech company is taking the lunch of MasterCard and Visa. Okay. So basically, American Express and Discover, despite being attached to a bank, essentially, because they do have to reserve loan losses, et cetera, they are part of the credit card network. And that is a moat that took almost 50 years to build. It will not be destroyed by PayPal, which is not even remotely a credit card network. It actually sits in this area called gateways. It can't be destroyed by PayPal. Let me show you what it means to be a credit card network. Okay. To be a credit card network means that you actually have this capability, which is called switching. It means that you can clear when transactions come in, you can take the payment. It's easier to see here. So you, number one, have the ability to issue a card. PayPal can't issue a card, neither can Stripe. None of the other companies issue cards, except for the ones that I mentioned right here, which are credit card networks. Okay, so number one, you issue the card, and then you have some way of taking in all of that data into a payment gateway, which is what PayPal does. And then you actually have the relationships with the banks to clear the trade. That's what took 50 years to create. Okay. PayPal does not have that. And then you also have to have the relationship with the merchants. Okay. Both. You have to have both. And if you don't have both of those, which took 50 years to build, you have no shot at taking over any kind of market share from the credit card network companies. And quite frankly, it's painful to build. No one wants to do it. So that's kind of where it sits right now. MasterCard, these are the only companies that have it. And within that group, the market share typically looks like this. UnionPay, which essentially has most of Asia, including China, is the biggest. Then you've got MasterCard and Visa, which take up the bulk of the rest of it. And American Express has probably gotten a little bit more market share from MasterCard, but that's it. But essentially, they have to be able to clear, settle, and authorize real time throughout the entire globe. And no one can do it but the credit card networks. And that is what it is. As a result, when you look at earnings, it oftentimes, when you're trying to compare across, you'll see like somebody being like, well, MasterCard trades so expensive relative to the others. Well, no, duh. It doesn't have to provision for credit losses. That's why that's the case. It's not a bank. It also, by the way, has 65% operating margins versus or gross margins versus American Express, Discover, and Capital One, which are closer to like 20 and so on and so forth. And also, by the way, there's no volatility to Visa and MasterCard. It just trades directly with transaction volume across the globe. So GDP growth is probably the biggest and most important. Whereas with American Express, Discover, Capital One, and literally everybody else, you got to look at rates. You got to look at rates across different countries. You got to look at currency trends, all this other stuff that is just not as relevant. Technically, currency is relevant for MasterCard and Visa, but it's relevant in a slightly different way. Won't go too crazy on that. All right. MasterCard crushed it, 8%. So here's what they did. You can see that MasterCard and Visa absolutely crushed it. Every single piece of transaction growth goes straight to EPS. Even if here you can see the net income differences, they are therefore using capital to buy back shares as they always do. Okay. Then here is MasterCard. And what you really want to see from these guys on economic data is what's it look like? Like who's spending what where? And the clear thing from all of them was that international has picked up. And that is here in MasterCard, right? Rest of world growth, 7% versus 8%. It's a little bit harder to see on MasterCard. Remember that MasterCard has a lot more debit business than credit card business. Here's Visa, very strong results, 29% increase in international data specifically. And then here is American Express. US is 26%, international consumer, much bigger than domestic consumer, international SME and large corps, significantly larger. So the card business international is picking up a lot faster than domestic. Now, why is that? Part of the reason that is there is because there is actually global improvement, particularly in the emerging market countries that, for whatever reason, this crisis have not taken it on the chin as aggressively as the developed markets have. Additionally, it is still the case that a lot of countries do not have a way to go paperless. And what COVID exposed was that you need to transition your financial system away from cash. And so they are essentially asking the American card companies to take care of that piece of it. That, again, is part of the reason why you will never be able to have one of these other fintechs that are on that other page ever take the place of a Visa, MasterCard, American Express, or even to some extent Discover, quite frankly, because their network is for reals. Okay, now let me go through a little bit more detail here on what that implies for what we're seeing in the way of credit land. Okay, cross-border transactions. Just in case we were not clear at all, cross-border transactions were very strong. So that means people basically going to another country and spending money. And also, this also indicates the pickup has happened despite China not reopening. Now, Visa and MasterCard are going to be far more exposed to China. American Express could get lift from China because they did get approved in 2020, but haven't done very much with it, in my opinion, to actually get that market share. But remember, what it implies is you have people going into China and people coming out of China to spend money because of the Chinese banking system. Typically, a Chinese person is going to use a Visa or MasterCard to do their financial transactions overseas. So cross-border transactions picked up even without China. That's like a really big deal for Visa, MasterCard. American Express with its 12% run up, I have mixed feelings about, but I kind of get it. Okay, this is Visa, MasterCard. You can see how strong it was and where it was. So the United States up 13% on, or sorry, the cross-border volume within Europe was 38%. Other cross-border was up 46%. So this is not Europe improving itself. This is actually the rest of the world, although very strong usage of Visa within Europe as well. And then you can kind of see, travel, other things that they're showing as to where people are spending money. Here is, this is American Express cross-border versus international. You can kind of see where that lays out. But it is a whole mix of consumer spending, card spending, what have you. The thing that actually makes me feel like this 12% upside American Express a little aggressive is because their third to fourth quarter wasn't as good as Visa and MasterCard's third to fourth quarter. And there's reasons for that, namely seasonality within the fact that they have more of a business travel mix to them. And you can also see through American Express, because they give you so much more division, what it was that people spent money on. You could see that there was a flattening of airlines and lodging, but restaurants up a lot. This is not necessarily the case. Really, you don't get the same division from some of the other credit card companies, but a lot of the banks told you that they still saw very strong travel and very strong lodging. So it's a little bit awkward that American Express is showing that. And that's part of the reason why this 12% up is a little aggressivo. Okay, now, this is also a big thing. What is it that people are going to do? And I think where you really start to see this is with Discover Financial. And these were the charge. Now, it's important to note that American Express is a small sliver of a certain type of person in the economy, which is essentially the upper wealth, up middle class and up. At best, you're middle class with an American Express because of the way they roll. Discover tends to go for the lower credit quality, essentially, but it's the newest of folks that are entering the lending field with a lot of student loans, a lot of personal loans, et cetera, in addition to the credit cards. And you can see that the charge-offs are really low for Discover. That is part of the reason why they were able to post, actually, in fairness, a better quarter than American Express. But a bet on Discover is a bet on the lower portion of credit spectrum. So that is kind of a thing to take note of. What that implies, though, and what's really fascinating about it is that they're not seeing the charge-offs even in the lowest credit spectrum. Now, what does that then mean for the entirety of the financials as you would trade them for the next quarter? Thanks, guys. What would that mean for it actually implies that there are really three strategies I'm seeing fall out across every single financial company that deals with lending. The first strategy, and the first strategy is really a Goldman Sachs strategy. And I want to just say, as relates to this, the reason that they're taking different strategies has to do with the cards that they were dealt going into this year and also the specific aspects of their business. But it essentially requires that you make a bet on the US economy and the timing. And so if you are thinking that it is definitely going to be just one more or maybe at best two more quarters, you would take one type of strategy. But if you're just flat out not sure, totally different strategy. So with the Goldman Sachs notification, their strategy was to take losses, clear the balance sheet, and preserve capital. And this was from their release. They took a $972 million L on credit losses that were related to the Marcus business, meaning even though those loans on balance sheet weren't showing huge credit losses, they wanted them gone so they could have the cash back to use it for things that were going to make more money. That's what I interpreted Goldman Sachs's quarter to be like. And so they would rather have the $1 billion back so that when the market reopens in the next whatever period of time, they can apply it and deploy it to growth objectives, which right now, none of the corporations are really talking about growth. They're all trying to preserve the fortress for the next quarter. All right. Hey, Tristan. Okay. So that's strategy one, which is preserve capital and take losses. Strategy two, and Zions Bank is by far the best example of this. It's so random. It's so random. Zions, sorry, there's some fun comments that you guys are putting and that are actually coming through. Okay, Zions Bank is taking a different strategy. Zions Bank is taking quality over quantity. They don't care if they don't get the upside on economic reopening. Instead, because they can lock in a certain rate of return, they're cool. They're like, look, I'm a bank. I don't really get a lot of love for posting crazy good numbers because I'm a bank. And so what I'd rather do is just post decent numbers and call it a day. The numbers that I know my investors can't get mad at. And then essentially I will even wind down the loan book and stop lending in order to do that. And I actually saw that in a lot of places. If you listen carefully to what Jamie Dimon's saying at JP Morgan, it sounds like that's what they're going to do. Citibank almost has to do it right now because of the nature of what they're doing. And then most of the consumer banks, with the exception of Truist, are doing more or less the same thing. PNC actually is doing more like Goldman. They're taking the L and making capital be their king and then waiting for the market to turn so they can slam down on the gas. So it's really, that's option two for strategy two that you're going to get to see. Now, strategy three is Capital One, and it's a bet. And if anything, it's the most aggressive bet within the financials. And I would say Truist is somewhat close to this bet. And the bet is really be aggressive, cheerleader style, which is, you know what? I reserved a ton of capital for COVID, and all I did was release that capital the next year, but y'all didn't give me credit for it. So here's what we're going to do. We're going to keep approximately the same amount of capital. I'm not seeing a lot of credit losses yet. I'm assuming I'm not going to see credit losses, and I'm just going to sit here and buy up really expensive loans. Okay. And that shows in a couple of different spots. That, first of all, shows up in spots like securitization debt obligations. So if you're going to start trading this, or if you're going to start watching this, these are the things you have to look at. Securitized debt obligations is definitely going to be a place. You will see that increase in size, and that will be metered. The other place you can look is CET Capital, because that will show in tier 2, not tier 1. And so you will see very flat CET Capital 1 ratios, or you might even see them go down to the minimum. Okay. So that's one thing. In some ways, Morgan Stanley kind of did this, but not really. So that's the other thing that you will look at that's kind of important. Is you will start to see, you'll have to watch the credit losses very carefully for where they're moving toward. And then the other thing is, what types of loans are they buying? The only person that increased the size of the auto lending book this quarter was Capital One Financial. Literally everyone else jettison the auto lending business as much as they could. And that is because autos really have a particular type of risk, not the least of which is also the risk of because it's such a short dated loan, unlike housing, which is a much longer dated loan, when the principal component starts to decline, in other words, used car prices going down, those auto loans can be really expensive for a bank as relates to how they mark them. So Capital One's the only one that's like, I got this. We're going to keep doing that business, and we're going to do whatever other business, because I don't buy this credit quality yada yada, and I'll just figure out a way to get capital one way or the other. So that's what's going on. Let me see if there's anything else. Oh yeah, So this is really, it's going to be pressure luck for these banks, which is why I think they should trade very interestingly. It's going to be about credit quality, CET capital ratios, which I went through, and then the size of those book of loans, but it's also going to be about timing. Okay. So if we are able to navigate out of this like rock star champs sometime in the first or second quarter, then really all these, the consumer credit portion will just rock out because you'll see transaction volumes go up. They'll have taken no losses. Those that have reserves are going to have to spit those reserves out. And it's going to look crazy good on all the financials. And then we're off into the races. The credit card companies, Visa, MasterCard, American Express, and Capital One, because of the nature of what it's doing, should all fly to the moon in that case, if that happens. If it drags out until the third quarter, much harder to say. Much harder to say. Visa, MasterCard should be fine. American Express should be okay, but you're going to have 3 solidly ugly AF quarters. And then Capital One, we'll have to see how they navigate through the second and third quarter. The investment banks will look horrible, and the regular banks, it'll be mixed depending on what they chose. And with that, I'll go ahead and hit the stop share. Oh, there's only one other thing that I would mention that I forgot to mention. If you're a crypto person, and this is interesting too, then go back. The one place that crypto touches this and is why MasterCard and Visa are probably some of the biggest investors in blockchain technology, but also very much so they show up to almost every crypto conference, is this thing right here that I was showing you before, clearing, authorization, and settlement. It's not the payment processors that are the biggest potential competitors. It's actually the cryptocurrencies that are. And in some ways, you already see MasterCard, Visa, et cetera, using a token in the middle to clear this. They usually, I think, use Ethereum, Ripple, whatever it is, to do so. And with that, I'll hit the pause button. Okay, I know that's really random for a Friday. How you doing, David?
Hi, Ming. Yeah, good. Great info.
Yeah.
Apple, seems like Goldman Sachs had an Apple card.
Yeah, they're yeah,
They,
that's what they don't want exposure to in quite the same way. They didn't really talk deeply about what they were going to do with that, but that is actually, so the Marcus business is what they're shutting down. The Apple Card business still remains, but it's for that piece that they ended up taking. They're like trying to get that off balance sheet. They want consumer, like they really do want the capital for other things. If you think about it from their perspective though, because they're not getting the cash that they typically get from investment banking, they got to figure out the cash somewhere, because if this market does twist, they need to, it's Goldman. Like they want to be on top of it.
right? Did they take losses on that card?
They took losses in general, credit losses. It's ambiguous which part of the bank it went for. I'm pretty sure it went for the cards business, but in fairness, it's not 100% clear the way they stated it.
Okay,
They
cool.
stated it as a mix of reserves is how they
It's a
stated
pretty
it.
cool card, but it's a MasterCard, I believe. No, it's Goldman Sachs. Goldman Sachs, never mind. It's aluminum. It bounces.
Yeah.
Okay, so
I don't have one.
okay,
I feel like such an old fart for not having one. Sorry, Jane. Even you're up with the kids. Do you have one?
right, yes.
You're hipper than I am. What can I say?
Right. Also, I have a PayPal card, right?
Yeah.
But it's
PayPal always attaches itself to either Visa or MasterCard with the cards that they
right. Well,
have.
then Visa, Mastercard get that business also. Right? They get fees for
100%.
that. Okay.
Yeah, because PayPal was always a gateway. That's why PayPal has competitors. MasterCard and Visa, their competitor is cryptocurrency. It really is. There's nothing else and even then, it's not truly quite correct to say that crypto is a competitor,
Okay.
because basically, if you want that money come back in the real world, this is how you think about it. If you need that money, if you think that money is just going to stay electronic and never actually have to come back to the real world, in other words, there's no person that you're paying, there's nothing, everything stays within a system, then you're fine. But if you need that money at any point to come back into the real world, in other words, if you have to pay that balance out with actual cash money, you're not paying it with crypto, you're not doing anything, then that's going to be always Visa, MasterCard every day of the week. So that's why PayPal is stuck, because they will never have that credit card network. It is a real pain to build. I mean, especially PayPal doesn't have the operating margins, neither does Stripe for that matter, or Square. So this isn't about Stripe, Square, and PayPal somehow getting together. No, this is actually a moat that was built over the course of almost 50 years. And if you think about it, the reason I'm saying it's 50 is the thing that it had displaced was cashier checks and more importantly, travelers checks on the cross-border payment system. That's what it displaced. And I remember traveling with a friend wanting to like tear my head out because she was still using traveler checks in 2008. I want to say 2007. No, we were in China in 2008. That's why I'm saying it took almost 50 years, because some of the emerging countries still, for a while, you weren't better off with a credit card than travelers checks. But sometime around, I would call it 2004, 2005, because I love the countries that are tougher. So I've been traveling to those for quite some time. Around 2003 to 2005, I stopped needing to bring travelers checks.
Right. What keeps PayPal, for example, from having a banking relationship like Goldman Sachs, for example?
Oh, okay. Here's the thing. Even Goldman, I think that card is not quite what people think it is. But here's the thing. Okay, first of all, PayPal isn't structured to be a bank in any way, shape, or form. That is a very different business. You have to provision for it. If they did it, it would draw a ton of capital out. That's part of the reason why. Here, let me stop sharing. This is also part of the reason why I get so hyped up and aggressive for people that try to compare Tesla to GM and Ford. See, GM and Ford have banks attached to them. And not only do they have banks attached to them, they have what I call poorly run banks attached to them, in the sense that even though, no shade to the professionals at GM Finance and Ford Finance, even though they do the best they can to securitize that out and get it off the balance sheet, the fact is they can't diversify their risk across asset types. It's auto loans or bust for them. And in fact, if they choose not to extend the credit, it 100% affects revenue for GM and Ford. Okay? Tesla didn't have that business. Anyone that has to be attached to a bank that has that business, therefore, must reserve capital against losses either that you incur off the loans that you write, or losses that you incur because of the marks that you have to take because you can't get those loans off balance sheet. That's the whole reason why I get really fired up when people ask me about Tesla and use this market cap nonsense, Ford, GM, blah, blah, blah. Okay. But guess what? PayPal, if it were to do the same thing, go the way of go the way of GM and Ford, so to speak, they would essentially become what Discover and American Express are. But Discover and American Express both they were there 50 years ago when people were trying to create these networks. Do you know what I mean? So it is totally, thank you, Sean, for enjoying my fired up situation. But yeah, so that's why it's so hard. See, could Discover and PayPal combine? Maybe, but neither of them really has the cash to do it. Like, it'd be dangerous for Discover because right now they got bigger fish to fry. American Express couldn't possibly want to go down client base into PayPal, so on and so forth. But that's what you would need to recreate something like that.
Cool, thanks. It looks like, from a macro, we've been bullish this market for a while. The macro, Visa and MasterCard, what you're showing is a very strong economy, right?
Yes, internationally. It's still pretty good. It's still pretty good domestically. Like right now, love him, hate him. I love him. Jerome Powell has done a good job as our Fed chairman. Okay. Like, I know there's going to be other people that hate on that, but he has managed to keep people from having massive credit losses in a big way. And some of that is that stimulus that everybody gets really mad about on the helicopter payments. I have mixed feelings about it too myself, but overall, the credit losses are very low across the board. And it gives him about 2 more quarters to sort it out. But I think after 2 quarters, you got to really sort it out because they can't hold on forever. So Capital One is clearly making the bet that by the 3rd quarter, with some improvement in the 2nd quarter, you're going to be in good shape. Now, here's what's actually happening for Capital One and American Express, where they're actually making the money as well. Well, more so Capital One, not so much American Express. It's a really different business model. But Capital One made a lot on net interest margins. And I want you to think about this. Most banks, the way they make their money is they take in your deposits, they give you nothing, and then they lend it out at something way more than nothing. But the credit card companies are special. They sometimes take in deposits. Capital One definitely takes in deposits, but then they lend it back to you at like 15% or something ridiculous. So their net interest income is crazy because they actually are, by almost definition, not lending out AAA rated debt all the time. Some of it's going to be like prime, some of it's going to be subprime, but it's all consumer debt, which takes a much higher credit spread. That's why those companies are what they are.
Yeah, I have some friends that own banks, and they've told me that when you their profit multiple is 40x. You give
Yeah, it's
them a
crazy.
dollar,
They
they'll
gotta
make $40.
watch losses. As long as they get the losses right, they're good to go. But man, when they get the losses wrong, it's a problem. That's
Right,
really what it comes down to.
right.
But as long as the consumer's stable, as long as like all these different things, credit losses. Now, this is not the case though for all credit companies. Like you guys, I've seen my video on Upstart. I think it's going to be a close call for Upstart. It'll be a close call for Carvana. It'll be a close call for CarMax because they are not set up to be doing that kind of business. They're not set up to eat the marks. Number one, on the loan book, which Capital One is set up to eat the marks on the loan book, given the nature of what they're doing, which is they're lending out at a ridiculous rate and then, wrapping it in and then whatever. So an originator is not designed to be a lender. And that is essentially what CarMax and Carvana are staring a little bit at,
Yeah,
as well
cool.
as that. So that's a little bit tougher.
Well, you mentioned helicopter money. If you Google a modern monetary theory, that's how that works. As long as you keep inflation low and the dollar is a reserve currency, then you can do the helicopter money. You just print it, and it's
Yeah.
okay. Modern monetary theory.
Yeah, it's true. I mean, we'll
Right.
see how it goes because we're about to have it play out one way or the other over the next year or 2 years, and then there will be a definitive comment on that. I did want to mention this one because this is actually an interesting comment, David. Even though you're joking and on my comments, it's actually a really good comment. To the extent that I think you have to wait maybe another quarter or two, but there is a set of people that are very clever and do have the ability to buy certain types of loans. So, for example, the private markets, strangely enough, one of the simplest places that does this are those like direct to consumer lending, like Lending Tree. I guess I don't remember the name of them, but probably more than one of you guys knows these kinds of lenders. So usually, when there becomes a lot of distress, such that like the regular banks are like, listen, we don't need to take your loan. We'd like to just make our quarter happy and not try to stress out too much about whether or not these loans are a problem. But usually, when it gets to a boiling point, which should happen not necessarily this quarter, but next quarter, if we still are not getting shifts in the rates and stuff like that, you will actually have the spreads widen. So even though you don't necessarily have an increase in default rates, the spreads will widen. In other words, in order for someone to be willing to write that loan and take on more risk, they're going to have to charge you a higher interest rate. And when that happens, sometime in there, especially if credit quality stays clean, if you have access to that market to buy those loans outright, that does end up being extremely attractive as an investment because you'll get someone that's prime, like 650 ish, or a bundle of people that are prime at 650. Just paying their loans. Maybe they're a little bit late, but you'll be collecting something like 10, 15, 20% on an auto loan. 15%, I think, is where auto loans already are for that group. You might even or alternatively, you'll have bought the loan, and given where you bought the loan out of the person that didn't want it anymore, you might even get another 2 or 3% off of that. So that ends up being a very interesting place to make money. It's just, I think it's a little bit early. You probably need 1 or 2 more quarters for that, depending on how your horizon is. If you want to hit the bottom, if you don't want to hit the bottom, I'm not the one that knows where to get that kind of deal. So look around, though. That's what you're looking for. Okay, that was cool. I feel like you've heard of this before, though, David, if not done it yourself, because you've been around the block. It's an interesting thing.
I've been around the block a few times.
But it's a true statement. All right. ISDA banks, Josh, I'm not sure what it is you're asking me on the ISDA banks. Every bank is going to be regulated by ISDA. So I'm not sure. I feel like people are throwing terms around these days, and I'm not quite sure what they're trying to get at. So Lucid up 56%. I don't cover Lucid, so there's a few others. On the rest of this, thank you guys for attending. I'm not 100% sure on the questions that are here on what they either mean or how to answer them. So that's the only reason. If for some reason you feel like I ignored your question, please put it in the comments and we'll try to go do a back and forth. I think I'm up to date now on all the comments. There are so many, but I do answer them personally. So if I'm a little bit late, it's probably because of earnings season. And with that, I'll end this stream. Thank you guys for coming. Really appreciate you. Take care. Have an awesome